You, yes, you. How much is your tech portfolio up over the past decade? If you said anything less than 300%, you're an abject failure. Simply investing in the NASDAQ over 10 years would have yielded 300%. What's that, you say? You're only invested in one or two stocks and you have paper gains of over 300%? Sounds like you're making one of the biggest mistakes of all. Today we're going to talk about why most tech investors can't beat the NASDAQ consistently over time. But first, a story. Somewhere around 20 years ago, I was working in tech startups and researching cool technologies. I came across something called liquid metal. And they had this demo with this little bouncing ball, and it sat there bouncing forever. And it was really cool to see, right? It was an amorphous metal, and Apple was going to encase all their phones with it. And I think the day that I saw the demo, I opened a brokerage account and bought shares in the company. I sold shares not too long after buying it. But 20 years later, the stock has lost 98% of its value despite this incredible story and value proposition. Why? Having an amazing story in the tech world, that's expected. Every exciting tech company has one. That's not what you should focus on. You should focus on looking for red flags because the problem is that most companies fail miserably. Most, Joe? Yeah, most. We recently did a piece on performance and it was quite remarkable. So over half of all stocks that have ever existed have lost investors' money over time. I suspect that in the tech world, the number is probably much higher than that. Another stat that we repeat often, I think it's worth repeating again, is that 95% of professional investors, these are people whose entire lives surround investing, they can't beat a benchmark over a long period of time. So why is Joe Retail in his underwear on a Saturday morning doing due diligence going to beat the market? And the problem is today social media has made pump and dumps even easier. So over the several decades that I've been researching stocks, I think the worst fleecings I've seen are around hype. And that's what we do here at Nanalyze is we build a methodology. And here you see the Nanalyze Disruptive Tech Investing Methodology. This is freely available for anyone to use and to look at. It's a 3,700-word document which reflects decades of mistakes that I've made when investing in tech stocks. Today, that's what we're going to go over. And if you're a premium subscriber, somebody who's paying us money, and you have any questions about this, you just fire me an email, respond to any email we send you, and address it to myself, Joe. First thing you want to do as a tech investor is define a universe of stocks that you would consider investing in. So there's no shortage of great companies out there. You don't need to bottom feed. I see people doing this all the time, trying to find the next hidden gem. First of all, small doesn't mean value. So for some reason, when they're looking for the needle in the haystack, they always gravitate towards small companies. I don't know why that is, but companies get that small for a reason. Do yourself a favor and avoid over-the-counter stocks. You're not missing a damn thing, seriously. Set a market cap cutoff. This is very important. Professional investors do this, and you should too. So ours is a nice round number, $1 billion. You can set that wherever you like. And we did several pieces on this actually, and here you can see the various size buckets that we've established and our own tech stock portfolio. I think we hold somewhere around 38 tech stocks. They're allocated across these size buckets, and premium subscribers have access to a chart actually that shows the allocation across each. Along the bottom, you see our target allocation, right? For stocks of all sizes across this entire spectrum, focus on the bear case. As I said, the bull case is always a given, and you take a red flag approach. What is that? Well, let's talk about some red flags. So over the years, I've observed these come up time and time again. So typically in the more shittier companies, they'll possess a single patent or a small number of patents or even a large portfolio of patents, and it will solve some big problem. What you'll then find is that they actually haven't monetized their IP, so they're not bringing in any revenues, or they're getting grant revenues. And when you look at their marketing materials, it's all about how massive the opportunity is, but there's very few details on how they actually plan to start generating revenues or timelines as to when that'll happen. If you go back in time, you'll see consistent broken promises. There's going to be paid research reports. That's where a bunch of sycophants set ridiculous price targets based on spreadsheets that are equally as ridiculous, and they basically just take whatever the company who's paying them, whatever they spoon feed these analysts. As I said, there's almost never revenues in a lot of these that help demonstrate traction in product fit. Grant income's not revenue. You're going to see a lot of individuals, man, this is as predictable as death and taxes. When you start criticizing a company, typically these will be rubbish companies, and you start getting attacked a lot by cheerleaders, that's a huge red flag, and they all use the same language and have the same accusations. What could that mean? Well, typically in the past, these were malicious individuals conducting pump and dumps. I think today they're probably some of the meme stock cult types that get brainwashed that a single stock is the answer to all their financial woes. Any constructive criticism, of course, is met by accusations of short selling. These companies will keep announcing partnerships, memorandums of understanding, which mean nothing, and other types of agreements that never actually go anywhere. That's very important. They'll communicate in an overly aggressive manner with shareholders, such as issuing press releases every day. We call this science by press release. The CEO engaging with instant analysts, that's a big red flag, man. Or the CEO being available to everyone. If the stock is listed on a major exchange, that doesn't assume institutional ownership means what you think it does. And we did a piece on the difference between passive and active institutional ownership that you ought to read. When the original opportunity doesn't transpire, the company will just keep pivoting. It's important to watch for that. Oftentimes, you can go back 5 years in the financials and find all the broken promises and use that as those are red flags. The ultimate sign that a company's not good is when their attorneys send us a cease and desist letter, right? So we've simply pointed out facts about a company, and of course they have no answer to that, so they try to intimidate us, which doesn't work. The big three, okay, so these are the biggest takeaways from red flags. No revenues, no interest, no exceptions, period. That single rule has saved us from more landmines than any other. $10 million per annum is the minimum when we talk about meaningful revenues. Gross margins need to be consistently positive. Don't confuse gross margins with operating margins. People do this all the time. They say, well, tech companies aren't profitable. Exactly. Yeah, that's why we focus on revenues. But a gross margin, the cost of goods sold, is a lot different from an operating margin. Stay away from small companies, as I said. Put a market cap cutoff in place. So just some notes here. We've seen a fair number of companies listed on major exchanges that raise many of these red flags. So it's not just small companies and over-the-counter junk. For example, some of the largest Chinese tech companies out there trade using variable interest entities, VI structures. These are a major cause for concern. Essentially, they say you don't have legal right to the shares that you think you're holding. Whenever we sit down to evaluate any stock, we always start looking for red flags. And I put this last one in here. It's worth noting. We've been harping about this for a long time, and now it's a mainstream criticism. That's when the DEI garbage, when you hire based on factors except merit. We did an entire video on that, which is quite good and worth watching. So let's talk about pure play stocks. So we call this the invest in everything with Google problem. And what it is that people say, well, you can invest in self-driving cars with Google, or you can invest in robotics, or all these different things. What Google actually does is generate revenues from ad spend. And of course, cloud is starting to come into play there. So you see, you need to dig into the financials to figure out what it is a company actually does. Revenue segmentations are usually provided in SEC filings so you can understand what exposure you're getting. What type of revenues are they? If they're product, then you have to pay attention to declining margins over time based on competitive pressures, as is typical in hardware businesses. If it's a service, well, if you throw bodies at it to scale, it's not going to scale very quickly. If it's SaaS, that's great. It can scale rapidly on the same cost basis. That's something we find very appealing. How fast is a firm growing? That's a proxy for market share being captured. Size of the opportunity. This is tough because a lot of firms will exaggerate this, but you can go around and get different estimates from third parties as well. Are they a leader? We like to invest in leaders. They enjoy economies of scale, and they're most likely to win in a highly competitive environment where people are fighting to capture market share. For multiple segments, which are the most profitable? This is worth paying attention to. I think Amazon's a classic example. You look at the cash cow cloud offering they have and how that funds their drive to expand internationally. Skating to where the puck will be works sometimes. So one example of where it didn't work so good was Teradyne. We invested in them for industrial robotics exposure, which never transpired. But a very good example of that would be NVIDIA. We invested in them back, I think, when they had 14% of their revenues for data center exposure. Now that's completely flipped, right? So that was a metric we were monitoring over time. So once you've looked at a company and decided it's something you'd you'd like to invest in, you want to pay attention to survivability. So yeah, we're in a bull market and everybody's a winner and everything's great and cash is easy to come by. But when it isn't, companies run into trouble, especially volatile tech firms. So positive gross margins are just the start. Watch out for companies spending $1 to get 90 cents in revenues. That's not sustainable. Scale is going to help create operating leverage. I like this diagram on the right. You can pause the video for a second and sort of digest that. It's really cool. It just says that your profitability increases as revenue increases. That's pretty cool, right? And you can see why in the diagram. In highly competitive spaces, sales and marketing spend dictates the leader, and I've seen cases where firms throw billions of dollars at sales and marketing trying to outspend their competitors in hopes their competitors run out of money first. Looking for leaders, that's why you invest in leaders. They're more likely to be able to raise money and have more capital to fend off the competition. Calculate your runway, so just look at cash burn, divide that out by cash on hand. Pay attention to dilution. Most investors don't. Pay attention to cash flows. So I love this quote, profits are an opinion, cash is a fact. And we do this stuff all the time. You watch our videos, you can see some examples. This is really quite simple. Doing due diligence, DD. SEC filings are the single best source of information. Then look at the glossy investor decks. Don't hang on every word management says. See people doing this all the time. You focus on quantifiable statements that they utter. Forget about what analysts are forecasting. They're largely useless. Company guidance, that's a useful indicator. What analysts on Wall Street think, that we find no value in. If you like what you see and you say this is a great company, that's when you should be even more critical. The stocks that you find most appealing, you should be most critical of. Nobody does that. Now, the IPO process, when a company goes public, it's especially relevant for tech investors because there are a lot of tech IPOs. It works pretty well. That's where you look at the S1 filing document. So for AI IPOs, for example, that's what we do. We take that S1 filing document, we go up somewhere peaceful, like this, and we sit there and we analyze the hell out of it and produce either an article for our premium subscribers or a video. And SPACs, we covered over 100, warned investors about them from day one. Those don't have the same scrutiny as traditional IPOs do. They don't have that S1 filing document. Instead, they have a glossy deck, and almost always those decks were miles away from where the company actually is today. The same holds true for reverse mergers. We used to cover these all the time. They're more frequently seen in over-the-counter rubbish. So let's talk IPOs for a second. Many IPOs tend to have a first-day pop, 18% on average, followed by a volatile early trading period that lasts a few days or weeks or even months. And that's based on 4 decades of data that covers 8,500 IPOs. Now, when we talk about that pop, it's for people that held shares prior to the IPO and then sold shares afterwards. So in order to take the emotion out of our investment decisions and to avoid chasing this price pop, which is purely speculative, well, it's a little more than that, statistically backed, but it's likely arbitraged away. We've established a waiting period for newly listed stocks. It goes something like this. We're not going to buy shares in any IPO unless they've published a 10Q or a 10K first. And when we do establish a position in a firm, we use dollar cost averaging. So let's talk about rules like that. When buying stocks, use dollar cost averaging. It works best. It takes the emotion out of the equation. We have a simple valuation ratio. That's market cap divided by annualized revenues. That's a good sanity check. It's good for relative comparisons. And for example, we don't invest in a SVR, simple valuation ratio, of 3 times our catalog average, which is 6. Our catalog is a Excel spreadsheets, a fairly large collection of data available for premium subscribers that details 460 tech stocks. Figuring out when to sell is the toughest part, honestly. And the question is, how well do you want to sleep at night? How much risk can you tolerate? And I think only experience is going to let you answer those questions. It's going to take some time. People who have wealth want to preserve it as much as grow it. So age is going to play a factor here in terms of how much risk you're going to want to tolerate. Now, we sell tech stocks for 3 reasons. If revenue growth stops, we exit. If the thesis changes, I know that's more subjective. A good example would be distributed manufacturing, a great example. We exit, right? So that thesis never transpired. If the stock becomes too overweight, we trim it. You can set your own rules around that. We have a pretty conservative rule of 10%. 1% in our own portfolio. It's pretty traditional for asset managers to set a rule like that. The cash that we generate from selling positions or trimming them is used for green shoots, so that would be tomorrow's mega caps. When it comes to investor relations, big red flag is when you have CEOs talking to small social channels. I won't mention one, but there's a guy out there who's doing a CEO who's very charismatic and doing interviews with some channels that are so small, I doubt it's worth the man's time. First of all, on the interviewer side, you're not going to learn anything from glorified salespeople. They're trained to talk to the media, so that's useless. On the CEO side, somebody should have vetted the people that individual, that highly paid, the highest paid person in the company is spending their time speaking with. And it needs to be, you need to have bang for your buck there. So it just shows incompetency when we observe that. CEOs available to anyone. I've seen this usually in total rubbish firms. Again, these C-level folks, their time is most valuable. It needs to be put to good use. As a shareholder, you should expect that, right? C-level types fraternizing with cheerleaders. We've seen a bit of this lately. This is a legal gray area, and it's likely going to get worse, right? I fully expect this to be a problem that arises down the road. Investor relations teams, they need to focus on providing a single updated deck on the value proposition. Surprisingly, a lot of firms don't have this. They need to provide earnings decks for each quarter. They shouldn't look like they're built in the 1980s. And ideally, they transcribe the earnings call so we can quickly read through it and get the points of interest. These earnings calls can be useful as an indicator of strategic or tactical focus. So when we check in with a firm, by the way, we check in with companies we're holding or thinking about investing in once a year. That appears to be the right cadence for us in that you're avoiding a lot of the quarterly noise. Analyst questions on these calls, they're hit or miss. Read the transcripts, don't listen to them, and oftentimes you'll glean some interesting bits. Be wary of pundits. There's a lot of them out there now. That's because there's no barriers to entry on social media. You have instant analysts, weekend warriors, and the classic 25-year-old life coach telling you how to live a successful life or how to be a successful investor. Many analysts out there who cover tech stocks have ulterior motives that go beyond trying to educate the masses. Here at Nanalyze, we focus on helping you become a better investor. That's our mandate. Many articles you'll see from mainstream investing sites will simply be clickbait lead magnets that try to get you to invest in a particular stock. Useless. Anyone who tells you to invest in a single stock instead of telling you about the importance of diversification does not have your best interest in mind. Now, our track record of taking out the trash speaks for itself, so we don't spend a lot of time talking about how great we are. Risk management basics. Have a spreadsheet with your net worth. Use Refinitiv to pull in stock prices. We did a piece on this. It's freely available for everyone. Understand what asset classes you have the most exposure to. So should you include home equity? Well, I'd say typically no, but rental income would be real estate, so would REITs. So maybe you would allocate when you're looking at your asset classes, break those out, right? Consider domestic bias. And people do this all the time. You want international equities exposure to supplement your overall portfolio or portfolios. The Bogle 3 Fund portfolio is a very risk-averse approach that works extremely well over time. We did a video on that you ought to watch. Any single stock shouldn't constitute more than 10% of your net worth. You can set that number to be whatever you'd like based on your risk tolerance, but you ought to have a cutoff there. You don't, as I said, want to have too many eggs in one basket. Of course, this advice always falls on deaf ears during bull markets, right? Those who see retirement on the horizon, though, they know the value of sleeping well at night. Last thing you want to do is get to retirement when you're at the bottom of a bear market, start having to sell assets when they're extremely depressed. Adjust your risk tolerance as you age. Making up for lost time doesn't work. I see a fair number of people reaching out asking me about this. Having a portfolio of tech stocks is a great idea. But make sure that's separate from your other assets so you can benchmark your performance over time. No sacred cows. Avoid anyone who promotes such behavior, like most people on the FinTwat space. They'll say things like, people don't get it, Wall Street doesn't know, my asymmetric investment approach. It's absolute horse, but it captures clout quicker. Bits and bobs here. ETFs don't always work. Cybersecurity versus gene editing. The former is quite mature. The latter isn't. So the former would have a lot of constituents. So you'd actually have an ETF. We've covered cybersecurity ETFs before, most of the top ones. What you can do when you're looking at an ETF is take a handful of the top by assets under management and compare their top 10 constituents. Obsess over fees, right? So Morningstar said the single most important predictor of a fund's performance over time would be low fees. Paper gains and losses mean very little. This is a volatile space. People talking about bragging about their paper gains on Twitter are just, you can tell they don't have any experience, right? Trading options and leverage should be avoided like the plague. So you see people talking about selling calls on tech stocks. That's a stupid idea. That caps your returns, right? So we've done a piece on options. As Buffett said, people who are experienced investment professionals avoid leverage, and those who aren't should avoid leverage definitely, right? So have a safe portfolio to benchmark your tech portfolio against, and it's highly likely you're going to lose money over time investing in tech. That's just the reality. And when over time, I mean not at the peak of bull markets, I mean over sustained periods of time. So I'm going to go ahead and leave you with a video we did on the Bogle 3 fund approach. I think we've talked about investing in risky assets. Here's probably one of the most surest ways to build wealth. So I'm going to leave you with that to watch. Please make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.